afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. It is lackluster day of trade for the markets on the weekly options expiry. The Nifty remains below its 20-day moving average of 10,960. Metal index is the top sectoral gainer as of now. The Nifty Bank is underperforming the Nifty after the Reserve Bank of India has given banks a 1st of October deadline to link all new floating retail and SME loans to an external benchmark rate. The external benchmarking of interest rates has also weighed on housing finance companies today. Both HDFC and LIC Housing Finance have seen a rise in open interest on the short side. And ONGC is off the day's high but still remains among the top Nifty gainers. The stock saw its biggest intraday gain in 5 years in the early trade today. Good afternoon, Neeraj. Well, it's clearly the banks which are dragging the markets lower today.
Yeah, well, they take the markets up one day, get it down the next day, so it's becoming very, very difficult to predict this. But remember, we were talking about how, based on the OI data, 10,800 might be the base and 11,000 might be the top. And we're kind of around those levels, really, for the Nifty. We wedged between there. Let's see, I don't doubt that we'll do too much if indeed that options data is to be believed. So very, very flat for the Nifty 50. Banks are cooling off a little bit from the highs of the day and not trading in the lowest point of the day, but certainly down there. I'll bring up the heat map very quickly and show you what's moving and what's not. Certainly, some of the financial names would be down there. So HDFC, 2.5%, that's a heavyweight. ICICI Bank, 1.5%. This is 2 out of the last 3 days. ICICI Bank has had deep gashes and amongst the top 2 or 3 losers. There is Kotak Bank, which has lost out about 1% as well. IndusInd Bank is down about 1%. State Bank of India about 0.75%. So that's the pocket. We don't see too much of red, but the market is flat because some heavyweights have corrected and the ones which are gaining are not essentially heavyweights. So you have some commodity names, some auto names gaining, but none of them are heavyweights. The top 10 gainers are all companies with weightage of maybe less than 1.5. So hardly any movers there which are worth their salt. But Tata Motors, Coal India, ONGC, BPCL, essentially the PSU pack, select auto names which are beaten down, and commodities because of what's happened to China economic data and the trade talk are doing rather well for themselves. That's the sum and substance of what's happening. Autos certainly doing well for themselves, Devina. So large pockets of green, but the market's still flat.
Yeah, and you've got the banks as the key culprits also. Amongst the larger banks, ICICI is for one down about 2%. But the broader market space too, if you take a look at what's been happening to the mid caps and the small caps, and we've got a gain of about 1/3%. So slightly better in terms of the gains here compared to the last few days where there's been an underperformance. So today it's a reversal of that. Dish TV for one has moved up about 10.5%. You've got the Buildcon, Reliance Infrastructure. Smaller names is actually penny stocks, Reliance Infrastructure, which has moved up. NBCC, HEG has moved up in today's session. Amongst the losers, LIC Housing Finance, that's down. Most of the high housing finance companies, they're seeing a little bit of a way down. Oberoi Realty down about 3.5%. Quest Corp 2% lower. And then you've got the likes of Mahindra Financial Services, 3 days of losses for this one. And Sterlite Tech, which was up yesterday by about, I think, 4.5%, today gives up about 1.5%. Quickly into the small cap index then. And you've got quite a lot of movers from here as well, doing better than the mid-cap space. Kajaria Ceramics for one is up about 5%. CG Power, 2-3 days now consecutively where you've been seeing about 5% gains coming in for the stock. Then you've got the likes of an Avanti Feeds, the likes of a Gen Irrigation, and Lemon Tree Hotels up 3%. What's not doing well is an Oriental Bank of Commerce, a few other names there. Jet Airways, a common name feature there. Soba Developers, and some of the other smaller banks which are weighed down in today's session. But what's been happening in the futures and options space, a quick snapshot of that. Navneet joins in for that. Navneet, good afternoon.
Good afternoon, Davina, and thanks for that. Well, it's banking stocks all the way where a lot of open interest build-up today has been seen. So starting out first with Nifty, I think marginally we have seen some bit of OI tick coming in for the Nifty futures, 5.5% higher. Premium has definitely fallen compared to yesterday's closing of somewhere about 45 points. And pull up Bank Nifty. Remember, yesterday's last hour rally was all about short covering, but today there is some fresh position being added on Bank Nifty. Open interest is up about 21%, and the premium has fallen from that 95 points to almost 44 points, telling you at every pullback that we saw for Bank Nifty, maybe at higher levels, there is fresh shorting seen for this index. And volatility index, which had cooled off in the morning when we opened in the positive, it had fallen below the mark of 17, but it's back above that mark of 17.6 right now. It's the weekly options expiry day, and we've been telling you what range you can watch out for. 10,800 on the downside to about 11,000 on the upside, and clearly there is some resistance coming around the mark of 10,900. We did trade above that mark at least for an hour or so in the morning, but there was some selling pressure seen. So if you look at the options data as of now for today's expiry, the 10,850 call has seen addition of about 18 lakh shares, and the 10,800, which closed with a premium of 20 points yesterday, is still seeing some bit of open interest addition. Almost 12 lakh shares have been added, which means that traders who have written the 10,800 put are safe till the time index trades around the mark of 10,780. So probably that should be the mark on the downside at least that you can watch out for today. On the stock futures side, Arvind is in focus. The stock's seen, it's a beaten down counter, but some bit of rally definitely seen. It's one of the top F&O gainers as well. Open interest is indicating there are some positions being built on the long side as the stock's up about 8%, open interest up 20%. LIC housing, the housing finance companies like this one and HDFC have been under pressure, but particularly for this one, it's fallen for the third straight session. And on the future side, fresh shorting visible as open interest has surged significantly here. And lastly, BPCL, this counter is up for the 9th trading day, so good gain seen here. It's also crossed its 100-day moving average, and today's gain has also come on back of high volumes in the cash side. As you can see on the screen, the white line is projecting today's volume vis-a-vis the average volumes of last 20 sessions. So good going for the oil marketing companies in today's trade.
Okay. Let's begin with the market voice. Rakshit Ranjan of Marcellus Investment Managers joins us right now on the show. Rakshit, good having you. Thanks much for taking the time out and speaking to us at Bloomberg Quint. It's becoming a bit difficult to figure out what the larger banking space could do on any given day or for a set of days, Rakshit, because the news flow is just so volatile out there. What's your sense? I mean, are you constructive on the markets? I presume you are, because Saurabh was speaking about this the other day. And if you are, can banks drive the next leg of the rally, or will they be underperformers?
So it's not going to be the whole pack which will either move up or down in the banking space, I think. So banks and NBFCs are at the heart of the ongoing moderation in the broader external environment because of the NBFC crisis and hence the liquidity issues facing various BFSI plays. It is also not the first time that we are seeing what we are seeing. Once every decade, at least, maybe twice every decade, we go through a similar sort of 6 to 12 month period. So whether it be 2008-9, whether it be 97-98 or 2013, this is exactly how it always plays out. The first couple of quarters, you see the poor asset quality players, the weaker liability side players undergo significant stress, and even the stronger, the HDFC banks of the world, the Kotak Mahindra banks of the world, in the first couple of quarters during such a crisis, we'll see a bit of moderation in loan book growth, even optically in NPAs maybe. But on the other end, on the other side of the crisis, once the worst is behind us, you will see a complete polarization of the industry in the banking space, where there will be maybe 5 at max 10 companies which will be substantial market share gainers. Within that, the top 2 or 3 will be compounding loan book growth rates at a very, very healthy pace. Their NIMs will expand the most. Their NPA percentages will be relatively very low, I would say, and hence you will see that sort of a pack doing very well. But on the other hand, you will have various other banking or NBFC players who either because don't have enough funding available on the liability side of the balance sheet, or for some other reasons, might not be able to grow their loan books in any healthy manner possible over the next, say, 2, 3, 4 years from now. So in that way, there will be, I would say, a polarization of the banking industry. You can't say the whole banking pack will lift the market up or down. When we invest our clients' money in the consistent compounders portfolio, we have about a quarter of our overall portfolio exposed to 2 or 3 BFSI plays, and those 2 or 3 we believe are the best position to benefit out of the weakness of others and hence report substantial market share gains over the next 2-3 years. So that's the way, according to us, to play the banking space, not the whole pack.
Okay. Rakshit, just comment on the fact as to when you're looking at a particular sector, do you look at the market leader, the market share leader within that pack? Because up until now, we've had conversations around how it should be that because you have a market leader, the scope to grow for that market leader is relatively less compared to the market share that somebody else, a smaller player, can come and draw out from the larger player in such a market. Is that a view that holds any water?
Yes and no. Why yes? So certainly if you really want to buy into deeply moated companies where the moat is very well established, that's our approach. We tend to build a very concentrated portfolio of heavily moated companies. The only way we convince ourselves that the moat is very deep rooted is by looking at long-term historical performance of that moat and the evolution of that moat. Now, once you are approaching stocks in that manner, certainly these deeply moated companies have become market leaders, and hence it is quite natural to expect a philosophy like ours to get gravitated towards market leaders in some segments. However, the reason why this doesn't apply as a thumb rule across all sectors is because it's also the market leader who defines the rules of winning in the market, and if the market leader himself isn't deeply moated, then even the leader is not best positioned to make money for himself. There are several examples of this. So let's say you take the airlines industry as an example, or the telecom industry as an example, or the media industry as an example. There are various market leaders who have in these 2 or 3 industries, and these are all large industries, well-established industries, and there are these market leaders who have sustained their dominance for several years, at times several decades, but they've not been able to make healthy earnings compounding over longer periods of time, because despite having leadership position, they don't have enough pricing power to be able to hold on to a healthy return on capital employed and also keep growing, right? So it's not by default that market leaders will deliver for you, but yes, there are some market leaders who've built their businesses around some incredibly healthy moats. And if those moats cannot be broken down overnight, then I think that's the safest. Because remember, safety in equity investing is more important than just returns. You get 20-25% returns without volatility compared to 20-25% with volatility. There's a meaningful difference between the two. So if you want to crush the risk, if you want to crush the volatility in your equity portfolio, then certainly you will have to go for well-established market leaders who are deeply moated. So yeah, in that manner it does apply.
Hi Rakshit, good afternoon. What's your market prognosis then, despite of slew of measures being announced by the finance minister in the last 2 weeks? FI participation has been absent, and of course the recent data point which has dented the sentiment of the investors is the GDP data, which is at a 6-year low. Do you think this could be a protracted period of slowdown for Indian markets and also for the economy, or do you see the tide turning anytime soon?
Well, I don't think we can pinpoint in terms of timing of the turnaround. Certainly there is moderation in the external environment. I don't think anybody can deny the fact that the external environment is weak. However, 2 or 3 things that we stay focused on. To begin with, even in a weak external environment, you will have stock picking capabilities, and more often than not, these stock picking capabilities are again with the kind of sort of consistently compounding heavily moated companies that I mentioned just now. The second thing is that the tide, the market's external environment, when will it start recovering? to a larger extent, it is dependent on decisions from the government, from various other bodies, and hence not in our control in terms of predicting the timing. But one thing is quite clear, that at the moment there is the bulk of the issue at the moment is around financing of the channel, or financing in general for even the end consumer, wherever is the financing which is a challenge. On top of it, there is certainly a bit of moderation for the last 3-4 years, which we've been seeing because of lack of enough job creation. So there are some, as long as you're talking about the NBFC crisis types of issues, that can be termed as a relatively short term, maybe over the next 12 months, maybe a little longer or a little shorter than that time period, we see a turnaround. But when you're talking about issues related to, say, weak job creation and hence impact on the economy, which has been ongoing for the last 3 or 4 years, that is a little more longer dated, I presume, in terms of potential recovery. But as I said, there is always a possibility to build a portfolio where some companies actually try to benefit out of this environment, because if the going is good for everybody in the economy, it becomes very difficult to differentiate the boys from men, or the good from great, right? But if it's a time period where the going is difficult, that's really when the great companies, they surge significantly ahead of the good companies or the rest of the pack. And hence, provided you can focus only on these, you will be able to make healthy returns for yourself and for your clients. So just to give you a data point on that, in the first quarter of FY20, which is the quarter ending June, the latest reported quarter, our portfolio companies delivered a weighted average earnings growth of 17%, and in the preceding quarter as well, they had delivered somewhere around 18-19%. Right, so over the last 6 months, when the external environment has been very challenging, we have fortunately managed to stick to a portfolio where high teens earnings growth is still coming through. And that's not just because of 1 or 2 companies in our portfolio. Almost 80-90% of our portfolio constituents have delivered more than 15% earnings growth over the last 6 months, right? So if you can stick to such names, not only will you remain resilient, actually the share prices of some of these companies keep going up at a time when the broader market is undergoing a lot of stress. So as a result, over the last 6 months, our clients' portfolios, in particular over the last 2 months, our clients' portfolios have remained very resilient. They've been in the green. The share prices have moved up, and hence that's the way I think is the only way to play in this weak external environment.
All right. Can you pinpoint for us areas of value creation? I mean, if you can talk about a stock, that would be great, but I'm sure you can't. So probably the next best thing would be to pinpoint one particular space where there is a lot of conviction.
So I can give you some color. I don't mind talking about a couple of examples as well as stocks. So to begin with, our portfolio always has been tilted towards middle class B2C household consumption items of sort of daily essential categories, smaller tickets in size. So that sort of a space, the core of Indian economic growth, which has been ongoing, the most resilient aspect of Indian economic growth, which is the middle class household. Now, whether it be the banking space, where we have a couple of banks, one NBFC, which are all retail small ticket oriented offerings in terms of their lending products, or whether it be discretionary or staples or home building materials, to begin with, our portfolio tends to be oriented towards the most resilient aspect of Indian economy. Having said that, as you just mentioned, even consumption is undergoing a deep distress over the last 6 to 9 months. But within consumption, within B2C categories, There are some companies, for instance, let's take the example of Asian Paints. I mean, I hear many people talk about it as an outlier for a variety of reasons. According to us, the biggest difference between Asian Paints and the rest of the B2C pack is there is just no distribution channel involved in the case of Asian Paints. As a result, channel financing has not been an issue that Asian Paints has dealt with. Now, this is something which is quite unique because no other mass market product in India gets sold in a B2C manner with no channel intermediation, barring, in Asian Paints' case, the last mile, which is the paint dealer on the high street. So there are no distributors, there are no wholesalers. Even the last mile sits on a couple of hours of inventory at best. He doesn't sit on, the paint dealer doesn't sit on a few days or a few weeks of inventory. So it's not working capital finance that can affect the demand of Asian Paints' products. Secondly, these types of companies also tend to gain market share in such an environment. So just to give you an example, let's say if a paint dealer is selling 100 rupees worth of products in a particular year, and Asian Paints is, let's say, 70 rupees out of the 100 he sells, then it is quite common to see that when the 100 for the dealer goes down to 80, Asian Paints sales don't go down to 56 from 70. I mean, there's not a 20% drop in Asian Paints' sales from 70 to 56. Actually, the 70 remains more or less unchanged, and hence, not only do you see market share gains, you actually see resilience even in the absolute terms for some of these firms. HDFC Bank is another player in our portfolio on the banking side. I mean, 17-18% loan book growth in such an environment is not a bad number at all. In particular, when the bottom is behind us for the BFSI crisis, there is a possibility that this number will accelerate over the next few years. So those are the spaces to begin with. Stay closer to the customer. Rely less on working capital of intermediaries when liquidity is an issue in the external environment. And within the end consumer, if you can gain market share, then nothing like it.
Well, thanks for those examples and good stuff on the portfolio. Rakshit, keep that up. Hopefully September turns out to be even better for you guys. But thanks for taking the time out and speaking to us today. Well, that's the view from Marcellus on the markets in specific pockets of strength and weakness. So on to the next conversation. Private banks and select housing finance companies are underperforming after maybe one reason could be that the RBI has set an October 1st deadline to link all retail and SME loans to an external benchmark for banks at least, not for NBFCs, mind you. Let's discuss the implications of the same with Ravikant Bhatt of India Nivesh Securities. Ravikant, thanks so much for joining in. Prima facie, which of the companies do you think tend to get impacted as a result of this new rule for banks?
Well, all banks, I would say, I mean, who are heavy on housing finance, as well as so you pick up any name, any of the large names. Most of them have built large housing finance portfolios amongst public sector banks, SBI, BOB, and then coming on to private banks. Even HDFC Bank has built up a housing finance portfolio. Even ICICI Bank has got. So when we're talking of this rule, basically, all the major names do come into the spotlight.
Okay. Ravikant, no, so I get your point. That's the easy part. All banks definitely would be. NBFCs thus far not would be. KK Mistry himself was saying that their teams will take a call on whether they also want to move to something similar like that or no. But my question was more from a perspective of banks having a larger portion of their accounts in this housing loan portfolio, and therefore, because of this, if there are higher tenor loans, they may have to reprice that, and therefore their returns in that fashion get impacted. Is it possible to give an analysis like that?
So, we need to see how this will play out. See, on the face of it, this seems to be very simplistic that, you externally benchmark and suddenly the rates start moving south because we are in a softening cycle. But mind you, we have been into the softening rate cycle for some time now. It's not that we are at the onset of the cycle. This rule becomes effective October 1st. The next policy action is on October 4th. So also expect banks, when they introduce this product, to also preempt some introduce spreads. for the new product. Secondly, how much more are the rates going to go down? I think with where the economy is, I think there are various expectations. The point which I'm trying to make is possibly what the banks may have to absorb here on might not be very significant. Two, the transition has to happen, but the transition will happen over a period of time. So when the base rate and when the MCLR was introduced, the entire transition happened over a period of 2 years. So yes, I mean, immediately start with the product, but then customers will come, they will move to the new regime, and that will happen over a period of 3 to 6 months, in my opinion. So the way I see it is, the challenge is not immediate. The challenge is over a period of maybe more of a 12 to after 6 months, it's more of a 18 to 24 month kind of a challenge that banks will have to contend with. And meanwhile, it might not hurt them immediately. But again, I mean, look at this. Banks will have to now find a way to balance both liabilities as well as balance the repricing on the liability side. And we are going to see, I think, a more discriminatory pricing, in the sense banks are going to be more discerning now with respect to credit scores, and you are going to, compared to the flat rates that were offered in the past, you might have a very differentiated rate going forward. Secondly, on the liability side, they are going to find a way to tinker with at least the large SA franchises are going to tinker with the use they offer on the savings deposit. So it's not very straightforward. It would not be exactly right to infer it's suddenly going to hurt NIMs in a big way. It is going to be a challenge in managing the NIMs, but I think it's not going to be very drastic as it is being thought.
Ravikant, the key concern, I guess, the street could be having on back of this news, and of course the reaction in the stock prices, most of your banks are trading with cuts after this. How much of this can have an impact on the net interest margins of these banks? Of course, they will have to now benchmark to the external benchmark rates, and according to the options, of course, given by RBI, the 4 options. But on an aggregate level for the banking space, how much of an impact can it have on the NIMs?
So let's see. I mean, we are talking of portfolios up to 28%. So let's say, I mean, housing loans are something like 13 to 14% of overall systemic loans, and you are talking of manufacturing MSMEs plus services MSMEs, which could take up another similar number. So a third of the book, a little less than third of the book, getting repriced. While you may not have a similar repricing on the liability side. So, possibly you could do a broad math on that. We have not done an exact number, but yes, I mean, some bit of impact on the NIMs is likely to be there. Again, I should highlight that banks are not going to stop at, just accepting, they are just not going to absorb a decline in loan yields and do nothing on the liability side. And if you were to look at the movement in cost of funds and compare that with how the repo rate has moved in the past, banks' cost of funds do react to the changing rate environment. There is a certain lag. But the decline in cost of funds is always not exact, but it will become more. Banks will try to make it more real this time around as they try to adjust to the new environment.
Ravikant, thank you so very much for joining us this afternoon. Really appreciate your thoughts. But as we're on the topic, let's hear out what some of the leading voices from the financial industry had to say about RBI's external benchmarking diktat. Listen in.
The volatility that customers will have in terms of lending rates in the new regime will be a lot higher than what they had in the earlier regime. We'll take a call whether we should introduce a product similar to this and keep the option open for a borrower to even take a loan which is benchmarked off a more stable benchmark where rates do not fluctuate that sharply. The more important thing is to see is how quickly your liabilities and how effectively the liabilities can be shifted to an external benchmark. You can shift assets to an external benchmark only after you shifted liabilities to an external benchmark. So the Treasury people will have to work out which external benchmark is the one which is most stable, where it is easier to shift liabilities, and then that benchmark will be the benchmark that will be used for assets. My off-the-cuff view is that it will be the repo rate, but that's my off-the-cuff view. The Treasury people will have to take a more calculated call.
Our experience is that one bank doing it doesn't work actually. I think the whole ecosystem has to develop actually. And if there are regulatory guidelines, it helps actually. So we'll have to see how it goes. As a banking industry itself, now that everybody will have to do, till now we had taken the lead actually doing these products on the asset side. Some public sector banks had joined us. Now that even the private sector banks will be there. So I hope that there will be something which will emerge on the liability side so that we are able to link on some of the liabilities at least. The options always are, of course, savings bank we did actually. What more can be done is something that will have to be examined. Bulk deposit is one option. I think there are small savers for whom probably linking to a floating rate doesn't make sense. But for the bulk deposits, maybe with a cutoff of 2 crore or 10 crore or 100 crore or whatever it is actually, if you link them to the floating rate, so it will help the bank to do the transmission on both sides of the balance sheet.
Well, that's as far as this development that happened overnight. Now, before we get in our guests, I think an important piece of research that we've done is on Indian steelmakers, which have taken a beating this year, and trade tensions have only exacerbated the global growth concerns. But a look at history suggests that maybe some of these valuation levels are points of time when people should have bought. Nikki Mitchell is here, standing here with that analysis. Nikki.
Well, thanks, Neeraj. Nifty Metal Index as a whole, given the fall that we've seen on YTD basis, that's the worst fall that we've seen since 2015. And steel makers clearly have seen sharper amount of contraction coming in terms of the share prices as compared to the non-ferrous sector. Three things that actually have led to this slowdown that we're witnessing right now is the strength in the dollar index. Apart from that, global prices have the meltdown that we're seeing, and the trade war tensions, which in turn have led to this kind of scenario. And domestically also, there have been a couple of factors like the softer public investment spend due to the general elections and the weak sentiment both in consumer durable segment as well as the automotive segment, which have been the reasons pegged by both Tata Steel and JSW Steel behind the recent down cycle. Having said that, let's talk about the valuation just to understand how lower these valuations are as compared to the two down cycles that we've seen back in 2009 as well as in 2016. Clearly, the valuations are lower in all the cases except for that of JSW Steel, which is comparatively a cost-efficient player and has got a sharp focus on domestic markets. But then look at the fundamentals, how they have behaved as compared to the valuations. If you look at the steel prices, to begin with, steel prices where we've seen dipping to around the $200-250 per mark, they have remained resilient around the $450 mark. In 2009 also they crashed. But then three things that stand out in this cycle will be the inverse direction of the raw material prices, that's the iron ore prices and the finished products. Apart from that, the supply side adjustments and the trade restrictions, which was not the case in the two down cycles. However, this time around, the domestic down cycle to an extent has seen some amount of slowdown coming in, which was relatively resilient in 2009 period and 2016 period. Having said that, the fundamentals still are strong, and just to understand if there is recovery in sight for the valuation of these companies, if you look at the trend that we've seen in 2009, 2008, we saw sharp valuations. 2009, we saw a dip coming in and then bounce back again. Same was the case in 2016, where we saw a V-shaped recovery to that effect. In 2016, we saw influx of imports essentially, and then measures which were being taken by the government. This time around also we're expecting same kind of bounce back, given that the valuations are now bottomed out around that 0.5 times price to book value.
Right. Nikki, thanks very much for that. Now let's bring you a Bloomberg exclusive. Bajaj Finance has picked bankers for its proposed $1 billion share sale. Rahul Sitija of Bloomberg News, he brings us more details on the same.
Bajaj Finance has picked up bankers for about $1 billion share sale. Banks including Nomura and Kotak Mahindra Bank have been selected. JM Financial has also been selected. More arrangers may be added later. The fundraise is happening at a time when its peers are facing a severe liquidity crunch, and this may help boost its lending. The company is planning to complete the share sale by December. Now, now remember that the deliberations are ongoing and the details could change over time.
Okay, thanks for that, for bringing all those details. But just shifting focus back to the markets, Nifty is at 10,836. Remember, the crucial level that we will be watching out on this one will be about 10,800 on the downside. But staying on with Bajaj Finance, Goldman Sachs has upgraded the stock, citing improving asset quality. And we've got Shefali Malik, who joins us from our research team to take us through the highlights of that report. Shefali, over to you.
Well, Goldman Sachs' confidence on the asset quality of Bajaj Finance has gone up as the company has been able to keep the delinquencies under control. Also, according to them, the loan growth would moderate going forward, but would still be stronger than the other financial peers. The fact that the company is increasing penetration in the under-penetrated areas is going to bode well for the company, and 55% of its loans are fixed. So in the current environment, when the interest rates are falling, the company is going to benefit, and it would be a key beneficiary of the government's and RBI's combined efforts to enhance credit flow to the sector. So some of these stronger NBFCs like Bajaj Finance, HDFC, etc., will command a better position. So the cost of funds are going to come down, and the margins are going to improve. This despite the fact that the proportion of mortgages in their book is rising to now it's about 29% of the book, and the competition is increasing in that space, which is leading to pricing power pressure. But despite that, Goldman Sachs think that the margins will be in a sweet spot for the company going forward as well. And they're saying that the stock price has corrected by more than 10% since the July peak on various macro and retail asset quality concerns, which according to them, that is, the retail asset quality concerns are quite overplayed and their book should be okay. So they're expecting the company to deliver strong return ratios, mainly driven by strong margin trajectory, higher cross-selling activity and improvement in cost-to-income ratio. So they've raised the target price by about 2% to about 3,916 crore rupees and have upgraded the stock to a buy rating versus a neutral call earlier.
All right, thanks a lot for that, Shefali. So that's, of course, words on Bajaj Finance. Remember, in the morning we did the annual report analysis as well. And now this piece of news for Bajaj Finance, about 1% higher in trade. That's about the time, the red mark was about the time when Bloomberg put out that news about the fundraising, possible fundraising, let me put it that way. Just a couple of stocks that I want to highlight before we get into our experts. JSW Steel, and that one particular stock has just come off a little bit from, I believe, the highs of the day. Marginally off. Remember, I think the approval has come in for Bhushan Steel Power. We'll try and get more details on that, but this is the piece of news, and that stock is correcting a little bit in the session. Let's get in our experts to talk about all of this and more. Aditya Agarwala of Yes Securities with us on the charts, as well as Jayesh Bhanushali of IIFL Securities. Gentlemen, both of you, good afternoon. Thanks so much for joining in. In a bit, Siddharth Khemka of Motilal Oswal will also be joining in on the fundamentals. Aditya, to you first, very quickly. The index, what's the call?
So last time I came over, index was taking support and inching higher. Bulls managed to take the index higher. But this week again, bears are dominating the index and markets are down. What is interesting to see is markets not making higher highs. On the contrary, they're making lower highs. So the previous high was 11,150. After that, index made a high of 11,050. And this week, we're not even able to scale beyond 11,000. So that is telling me that the bears are dominating the index yet. From a day or two perspective, I believe markets can consolidate in a range on the upside. 10,900 to 10,930 is acting as a stiff resistance where there's a good supply zone. On the downside, bulls are probably trying to support the markets around 10,800 to about 10,820. My sense is there's no trade zone. Let the markets consolidate for a day or two. Moment markets break out of this resistance of 10,900, 930, then a long trade can be initiated for targets of 11,050. And hoping that market crosses 11,050, then we can scale 11,150. Until market does that, it's best avoided the index.
Okay. Jayesh, what would you do on the Nifty or the Nifty Bank?
In Nifty, we have a positive view. If you see the option data, for today, it is indicating that the expiry would happen between the strike price of 11,800 and 10,800 and 10,900. If you see 10,900 call option has added almost 56 lakh shares of total open positions, and 10,800 put has almost 37 lakh shares in open positions. So I think these positions are short gamma positions. So it is indicating that today it will expire in this range only, and from tomorrow we may see upward momentum in Nifty, which can take the index higher up to the levels of 11,000, which is where the immediate resistance is.
Okay.
So we would recommend to go long with a couple of days time horizon with a target of 11,000.
Okay, that's on the Nifty. Any stocks, Jayesh, that you would like to highlight for us this afternoon?
On stock specific, I think IOC is looking decent in today's trade. I think the stock has added almost 12 to 13% in open position since the start of today's trade, and the stock price has surged 3.5%. I think you can enter the stock at current market price with a stop of 122, and the target price would be 135. Even on charts, if you see, the stock is on verge of giving a double bottom breakout. So I think we can see a positive momentum going forward.
Okay, in fact, the oil marketing companies have been active today. Even BPCL is witnessing some fresh longs today. But Aditya, in terms of individual stocks, what are you recommending?
Yes, so I've got a couple of recommendations, one a buy recommendation, the other is a sell recommendation. From the pharma pack, I've picked up Aurobindo Pharma. Pharma is definitely looking one space which is providing some sort of a support to the markets, and considering the fact that the other pharma stocks have moved up, it's time for, I believe, Aurobindo Pharma to move up. It's consolidating in a narrow band right now. On the downside, 580 happens to be the support, on the upside 615 happens to be the resistance. My sense, it's time before Aurobindo Pharma breaks out on the upside. So a long recommendation is recommended out here for targets of 638. We'll place a stop somewhere around 585. The sell call is on Tata Global futures can be shorted at current levels. Stock is on the verge of a breakdown from a trendline support. Negative divergences are seen on multiple time frame charts with respect to RSI. So that tells that there is a weakness creeping into Tata Global beverages. So one can initiate short positions for targets of 256, place a stop somewhere around 273.
Okay, so that's a couple of stock recommendations from Aditya as well. Let's get in a fundamental voice on the show. Siddharth Khemka of Motilal Oswal joins us right now with his thoughts. Siddharth, good having you. Thanks so much for joining in. Metals are in news today. By the way, sorry, some news flashes. Okay, there's the same news. India has allowed the sale of $2.7 billion assets to JSW from Bhushan Power. Siddharth, come in on that because it's related as well. The second question will be on that. First, the uptick that we're seeing in the metal names. China economic data looking okay, maybe some positive news on the trade resolution, though it's always up in the air. Would you go out and buy some of the steel or the base metal names at the current valuations? Why or why not?
Yeah, good afternoon. Good to be on the show.
Thank you.
If you look at the entire setup, the globally things are moving on a slower path. There are concerns of a global economic slowdown. And which has led to the current down cycle in a lot of commodity stocks, including the metals. Now coming on to specifically the Indian metal stocks, they have corrected, and definitely they are trading at much lower valuation than the previous down cycle period. But the current concerns that has been the global trade war led recessionary kind of a scenario which could emerge are keeping the views, at least for some, from a medium term perspective, a little bit cautious view on some of these base metals. Yes, right now based on the valuation as well as based on some news flows from China, there seems to be some pullback which could at best according to me would be a trading opportunity in some of these metal names. But for long-term investment, I think there is still some time when we see the global economy stabilizing, and that would be a good time to start looking at some of these names.
Okay. Well, speaking of steel, Upamanu Trivedi of Bloomberg News joins us right now with more details on this news flash surrounding JSW Steel and Bhushan. Upamanu, what do you have for us?
The National Company Law Tribunal has approved sale of Bhushan Power and Steel to JSW Steel. This makes Bhushan Power the second company acquired by JSW Steel under the insolvency process. It had last year acquired Moated, and it also helps Bhushan Power expand its footprint in the eastern part of the country where it was so far absent. Now, the court has said a few other things as well. One of the most important ones is, which is also a minor setback for JSW Steel, that the profits acquired by Bhushan Power during the corporate insolvency resolution process period will be redistributed among operational and financial creditors, as the National Company Law Appellate Tribunal has held in the ArcelorMittal case, which is although under appeal in the Supreme Court. This is a minor setback. Besides this, the court has clarified that the criminal proceedings against the former promoters of Bhushan Power will not impact JSW's resolution plan for the company, and also that all the existing laws regarding taxation and all other laws will apply equally to the company, and the Committee of Creditors and Resolution Professional will conform to all those laws while implementing JSW's plan. The court has also appointed a monitoring committee to oversee the implementation of the plan, and has approved JSW's plan with these conditions.
Okay, Upmanyu, thanks a lot for joining and taking us through all those details. Well, some relief coming in for JSW Steel. Remember, they had approached NCLT against the cases which were initiated by bankers like PNB as well as Allahabad Bank against the former promoters of BPSL. So some relief, but since the time the news has come, you've seen the stock of JSW Steel reacting now. Not sure if this is good timing for a company like JSW Steel to buy such a big plant when the cycle has actually turned. We've seen the metal stocks correcting, the prices of LME have also been correcting. So, a take from you with regard to this news, and also do you think the timing could just go wrong with regard to acquisition of a new plant when the cycle's not turned at all?
Yeah, Navneet, you have rightly highlighted the news comes in at a time when the cycle is turning on the other side. However, if you see some of these assets which were much sought after, given that they were capacities which were there in the system and were leading to overcapacity in the country. So for the resolution itself is a welcome move for not only for JSW but also for the banking sources and the faster resolution under the IBC. But right now it will definitely add on to a capacity in a down cycle for JSW, which might be negative in the near term, but definitely a good asset to acquire in the long term.
Okay, got that. That's in the metal space as a whole. We've seen some excitement around some of these names at least. But if you take a look at Coal India, NMDC, production levels have not been met. In fact, we've seen a dip in overall production numbers. Coal India in particular, it's come off from those lows of almost 170 that it had touched, now at 194, so inching back towards 200. But Aditya, Coal India, would you buy from these lows?
There can be a short covering rally. Most of the stocks are showing good recovery, and volumes have been quite decent in this pullback that we witnessed today. But I would not eat too much into it. Probably there can be a move towards 200 levels from current levels of 194, 195 at max. On the downside, supports should emerge somewhere around 190. So it could be just a day trade or a couple of day trade. That's it, not beyond that.
Okay. Well, that's Coal India. The PSUs, by and large, as a pocket, have done rather well for themselves. Siddharth, if indeed there is some review, and again, I do not quite understand in which way will it benefit. There was some talk of how maybe if the ETF's route is being reconsidered, the crowding out of PSUs might get impacted and it will become lesser. Though I, again, don't quite understand the modalities and how will it benefit in a material way, because these shares don't come to the market. They essentially get transferred to the AMC account any which way. So there's no large offshoot coming in the market, save for the fact that because the ETF happens at a discount, the perception of what the price happens gets impacted. But what's your sense? Is that a good enough reason to go out and buy into select PSUs, that the route of ETF might become a bit slower?
Yeah, so I think the market is taking that in a positive way, mainly on account of lesser supply, at least in a time when the valuations have fallen off, stock prices are at lows. So that is a positive, at least from the near term, where the market believes that the supply will come down. The second part to it is that I think there is a hope from the market that there could be some strategic sales, at least of some of the smaller PSUs where the government is having a rethinking and might get private players, which could lead to efficient operations in the future. If you see some of the larger PSUs, I think this is one of pullback, at least in the names of, say, Coal India or some of the other names where the operating performance has really not picked up. However, if you see the valuations are at almost 5-year lows, the stock prices are offering a good dividend yield. It's not that the business has gone away, and they continue to generate good free cash flows. So to that extent, someone looking at a defensive bet in this market could look at some of these PSU names. Coal India is one which comes to my mind. The dividend yield is now in excess of 10%. Stock is trading at almost 5 years low. So not for the general public, but definitely for people who understand the risk and nuances of investing in the PSUs, given that a lot of news flows as well as policies affect their business and operations.
That's Coal India for you. Technically, there could be a short covering rally in today's session, but remember the production numbers for the month of August, they were down about 10% on year-on-year basis at a time when FM announced FDI into commercial mining as well. But Coal India itself has not been able to tap on to the capacity that they have. In fact, the production and the sales both were down for the month of August. Okay, markets could be down, but there is short covering rally actually seen for a lot of these stocks. So Coal India could be one of them, but pull up Arvind, which we highlighted at the start of the show. You've also got among the nifty constituents, Tata Motors is up about 6% in trade. Kajaria Ceramics, another F&O counter, that's seen gains of about nearly 5 to 5.5%. Aditya, if I could come to you on these beaten down stocks which are bouncing back, would you play this pullback or would you avoid any one of them, be it Arvind or Kajaria Ceramics?
So the two names, Arvind and Tata Motors, will definitely avoid on my list because they're trending downwards. This is just a one-off move that we are seeing. Probably can last for a couple of days, but nothing too much to it. For that matter, I'll completely avoid. Kajaria, on the other hand, can be one stock which can be looked at, definitely. So this is yet to get into those zones where it continues to make lower lows. There's good supply zone around 500, so probably I can look at the stock towards 500. If it crosses 500, I'll hold on to it for targets of 550. On the downside, 450 is a good support zone. So my sense is if one has to pick out of these three stocks, I'll go in for Kajaria.
Okay, Kajaria can be looked at to play on the upside. Heavyweight HDFC with nearly 10% weightage has been dragging Nifty lower today. The stock's down about 2.5%, almost at day's low. Jayesh, where do you see the support for HDFC? Let's say if already somebody's initiated shots here, according to you, what can be the target?
In HDFC Limited, if you see, the stock is currently trading at its 200-day EMA, which is placed at 2043 odd levels. So I think this is where the actual support in the stock is. I think for this week, I think 2000 to 2040 would be the ideal rate wherein the stock would bottom out for this current downtrend. And again, we may see stock recovering back to 2120, 2140 odd levels going forward. So from the levels of 2000 to 2040, I am expecting the stock to bottom out and we may see uptrend again.
Okay. What else? HDFC, I think 2036 or 2035 is, I believe, the 200-day moving average for HDFC. Do watch out for that one. 3 million shares traded today. So the size has been pretty big. We are awaiting a few things, right? We are waiting what Reliance Jio would do in terms of their broadband pricing. Ahead of that, we're seeing some interesting price moves. I mean, Dish TV, I don't know if there are other reasons involved, but Dish TV is up about 8.5% in the session today. So let's wait and watch what happens to this stock. over the course of the next few hours, if the announcement comes in during market hours or otherwise. So that's an important one. The other one which is doing reasonably well today, not quite related there, is Ramkrishna Forgings. The Class 8 truck sales data wasn't quite spectacular, but the stock is doing well for itself. So not bad going here. Siddharth, have you guys done some analysis at Motilal Oswal about whether what Reliance Industries does with the broadband offers, will it cause any kind of disruption within the different facets of the industry that might get impacted, be it broadband, be it DTH, maybe the first day, first show offer and the exhibition companies, anything at all?
We looked at it, but I have not studied that part, so I will not be able to tell you on that.
Any thoughts on Dish TV at all, Siddharth? Do you guys look at that one?
Yeah, so basically, apart from the overall the launch by Jio, which had impacted the other issues, which was impacting Dish for some time now, is the debt on its books, as well as the promoters which had put Dish TV on the block, and the M&A which would lead to some consolidation, further consolidation in the industry. In terms of valuation, definitely they were to do profitability, at least on the EBITDA front, but on the PAT is something that has been elusive for the stock for some time, and that is something that has been in the waiting, that this will become profitable. But after the launch of Jio, I think that is something which will be further delayed, and to that extent doesn't excite us, at least to look at something like Dish in the current environment.
Okay. I was wanting to ask you about RNAM and HDFC AMC. Do you have a constructive view on Reliance Nippon Asset Management now as a catch-up play, or has it done its bit of a run-up? Siddharth.
Yeah, so we do not actively have started looking at the AMC businesses. So we don't have coverage on an HDFC AMC or RNM as of now. But going by what is reported in the market, it definitely looks like there could be further upside to an RNM, given that the huge discount that RNM trades to an HDFC AMC. And we have seen that in the recent market, HDFC AMC continues to attract premium valuation compared to what it was trading some time back. And with the change in promoters, especially in the RNAM, and the stability in the AMC business, that could catch up is what I believe.
Siddharth, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
Yeah, welcome.
That's the view from Siddharth Khemka of Motilal Oswal. Well, moving on to some other news and updates. Union Minister Nitin Gadkari says the government may look at reducing the tax rate for hybrid vehicles. Speaking at the SIAM convention in Delhi, Gadkari said it is in keeping with the government's effort to fight pollution.
हमने जो इलेक्ट्रिक व्हीकल है उसके ऊपर जीएसटी कम किया है. अब मैं कोशिश कर रहा हूँ कि उसमें जो हाइब्रिड है उसके लिए भी सभी उसी प्रकार के लिए फाइनेंस मिनिस्ट्री सोचे. मैं उसका फॉलोअप कर रहा हूँ, आप भी करिए, ताकि उसके कारण वो भी उसमें कवर हो जाएगा. स्वाभाविक रूप से आपकी मांग है कि BS6 के कारण ये जो कॉस्ट बढ़ी है, इसलिए पेट्रोल डीजल के व्हीकल में भी टैक्स में कुछ कमी होनी चाहिए. आपका सजेशन अच्छा है, मैं जरूर फाइनेंस मिनिस्टर तक पहुंचाऊंगा और उसमें कंसिडर करने के लिए कम से कम कुछ समय के लिए इसको विचार करने लायक अगर कर सकते हो तो मेरे तरफ से उसका फॉलोअप मैं निश्चित रूप से करूंगा.
Okay, but auto players may need far more than just rate cuts to revive sales. Honda Motorcycles and Scooters India, for example, is depending on a sharp sales pickup in the festive season to clear their inventory as well. And Nishant Sharma actually caught up with the company's CEO and senior vice president to find out if prices will actually rise with the new emission norms kicking in. Listen in.
We need to increase the price because of BS6 new emission norms from between 10% to 15%. That's another challenge to convince customers.
Mr. Galeri, I'll ask you about the dealership network as well. We were in conversation yesterday with a lot of dealers in the country. there's a sense of fear that the festive season will also not be able to bring that much of relief to the industry. What are you seeing?
See, first is that, any such announcement, there are always two ways to look at things, whether you see the positive side or negative side. As Mr. Kato said, that this transition of BS4 to BS6, always we have been maintaining as Honda that we see it as a very positive opportunity. There is a challenge, of course, once you are upgrading from BS4 to BS6 in a very short time. That was a challenge. However, as industry as a whole, they accepted this challenge and this transition is being made. And what we had decided that it's not simply that a product A will only meet the BS6 as from the environment and the regulation point of view. We saw it as an opportunity to add more value to the consumer and the customer because the price point is going to change. In this price point, what is that additional value in terms of new features and new technology, which maybe the global customer is already experiencing, but an Indian customer has still not, accessed or used that technologies.
Where are we at the inventory levels? Because there are still at the higher side of it.
Yeah,
right?
currently based on our own market intelligence, we still believe that Honda dealers are comfortable compared to the industry standard. Of course, because of the prevailing condition, it is not the same level what it used to be earlier, because unfortunately this is the overall situation of the industry. However, still with our moderation of our production and trying to align it with the actual market demand, we have been able to control it to around 45 days of physical inventory at our dealership.
Okay, Uday Kotak has a relatively different stance in this situation. Speaking at the same event, the Vice Chairman of Kotak Mahindra Bank says part of the slowdown is due to better efficiency. Listen in.
I think the auto sector really needs to focus on is be aware of some of the major structural changes which are happening in front of us. And the most important example I give is that of my son. In my time, when I was starting my career, to buy a car was a status symbol. Gadi li. My son believes a lot more in Ola and Uber, and therefore is far more comfortable with the Olas and Ubers of the world, and which is the classic situation of capacity utilization, friends. At an average, a car must be used at a capacity of 3 to 5%, and Ola, Uber will have a capacity utilization of 40 to 50%. And if there is a behavioral change which can become structural, we at the auto industry need to be ready for this structural change which we may be undergoing, and we may not be seeing the trends fully. The second big change, and I give credit to the minister for that, our highways have become more efficient. Octroi has gone away. That has increased efficiency of the trucks and the vehicles, as a result of which there is better capacity utilization. I call this as good cholesterol. It's a structural change which is positive for the economy, but in the short run leads to some impact on demand. Third, I think the government was bold enough to take a very significant call, which is allow the truck vehicles to have additional capacity utilization per truck. When you do that, you do have an impact on the short-term demand for trucks. And therefore, we really need to do what are the changes we think will happen both on the structural side as well as the cyclical side. And on the cyclical side, I will divide the challenges into basically two parts, demand and supply. On the demand side, I just want to reassure that banking industry is ready to finance any form of vehicle, two-wheeler, three-wheeler, four-wheeler. And there is enough liquidity in the banking system today. However, I do believe that the idea of having a captive finance company, as many of the manufacturers already have, is a good one, and that is something which can help demand. At the same time, from the point of view of the financing industry, friends, one of the challenges which we are facing is that we have started depending on the credit scores of individual consumers. Now, as the economy slows down, there is an impact on the credit scores of each of the consumers. And if there is a drop in the credit scores, the amount of borrowers to whom credit can be available starts coming under pressure. Therefore, the marginal borrower who 2 years ago was getting financing easily stops getting financing today because the credit score impact is happening in the financial industry. So I do believe that banking and finance will be there to finance the auto sector, but the credit scores and tightening of credit underwriting is also happening at the same time.
Okay, Nifty is just about flat right now and 25 minutes to go for markets to shut shop. And let's see if there is more volatility in store in the last half an hour of trade, considering it is the weekly options expiry day. But no sharp recovery actually seen for Bank Nifty. That continues to reel under pressure, at least down 180 points. Very quickly, let's take a look at the globe as well and check how the European market indices have been trading so far. I think largely it's positive. CAC and DAX are sitting with good amount of gains, but some bit of losses definitely seen for FTSE 100. That's down about 0.5% right now. But back home, there are a lot of stocks which are moving around, maybe on back of short covering rally or genuine buying, but which are the Fab 4 stocks today that feature into Sharad Dubey's list. Let's go across to him and find out. Hi Sharad, good afternoon.
Good afternoon, Navneet. The first stock from the small cap space is Elcon Engineering. The stock went up as high as almost 9%, its biggest intraday move in almost 11 months after the company received an arbitration award against BGR Energy for around 37.5 crore rupees. Up next, we are having Ramkrishna Forgings, which is up almost 6.5% after North America's Class 8 truck orders came up and which rose almost 6% to 10,414 units on a quarter-on-quarter basis. Up next, we are having Arvind, which is up almost 6.5% as traders take fresh long positions, and a high open interest of almost 21% has been seen. And the last stock of the day is Dish TV, which is up almost 8% and trading at high volumes of 2 times its 20-day average. And we'll be also looking out for the Reliance Jio's announcement on the fiber space. Back to you.
All right, Sharad, thanks a lot for bringing those Fab 4 stocks of the day. I just want to highlight some stocks which have gone up quite significantly. One of them is Shankara Building. I think that's very close to being locked in upper circuit, up about 19% in trade. You've also got something like Kiri Industries, which has risen, and the volumes are quite decent there as well. Kiri Industries is sitting with gains of about 16 to 17%. The gains have, mind you, just come in the last 15 to 20 minutes of trade. And how we've been talking about the PSUs doing well today, you've got Hindustan Copper, which has surged about 8% right now, sitting at levels of 33.9. Let's bring in our next guest on board then, Mayuresh Joshi of Angel Broking joins us. Hi Mayuresh, good afternoon. Well, a breather of sorts for the markets, though the banks are trading with some bit of cuts after the news came in that RBI has asked the banks to benchmark their retail loans, and that too on the floating side, to external benchmarking. And I think the banks more or less have reacted negatively to that. Let's start off with that then. What's your take on this? And because most of the analysts have been highlighting this could lead to some bit of dip in the net interest margins of these banks.
Afternoon, Navneet. No, so the clear move that the government has probably embarked upon in terms of benchmarking of lending rates to the repo rates. Obviously, I think the expectation of transmission of rate cuts are mandated to be followed by these banks. And what kind of an impact does that have on NIMs? I think the base case scenario obviously works out that the NIMs and spreads will get impacted. But I think each individual bank probably needs now to probably dwell deeper into their asset liabilities and how the entire maturity profile is specifically on the deposit side, and whether they can, depending on the maturity brackets and buckets, deem that to be getting lower. So again, I think there will be an impact on NIMs and spreads. To what impact, I think the street is a little unsure at this point of time, and that's the whole reason that you're probably seeing the entire banking space probably being under pressure at this point of time. So yes, I think it's an individual banking take, in my opinion. I think banks which have a better handle in terms of their asset liability management, I think they should probably skate through with lower cuts and lower losses on their NIMs.
Mayuresh, just to follow on that, of course, this move is not mandated for NBFCs, but we've seen some negative reactions also coming in for HDFC and LIC Housing. KK Mistry spoke to Bloomberg Quint in the morning, and he clearly highlighted a move like this will only bring in more volatility when the cycle turns. Do you think now that this is mandatory for banks, it will induce competition going ahead? And do you expect these NBFCs to react to this tweaking of rates?
They will as well, Navneet, because I think the kind of borrowing mix that NBFC have from the banks as well, I think with lowering of rates coming through, I think they should be prima facie beneficiaries. But what probably happens in terms of the overall passing of these lending rates, lower rates to the end user as well, I think you cannot enjoy a massive spread on that as well. So I think there will be intense competition in the NBFC bracket as well. I think the higher borrowings on the bank side, I think will entail pass-through happening for the end consumer. And again, that will entail into a huge amount of competition. So what Mr. Deepak Parekh probably said, I think to a certain extent is absolutely right, I think. So to that bit, again, I think the kind of competition pressures that can come through on the NBFC universe can also get played out.
You know, I'm reading this note since we're talking about banks and NBFCs. This is the Morgan Stanley Asia Pacific note on HDFC Bank. They're saying that this, I mean, the title is that this compounding machine continues to roll. Their target price is 3,000, and lest it raise some eyebrows on valuations or otherwise, must tell you every single time somebody's thought of HDFC Bank being expensive and not bought it, 2 years down the line, 3 years down the line, it gives you that 15% CAGR, and the person loses out. So if history is a barometer, HDFC Bank has always rewarded, no matter when you bought it.
That's right. In fact, at every correction we've seen, and especially in a market like now, which is so volatile, there is so much of uncertainty, be it domestic or global factors. Where do you put your money? Probably you look at quality stocks as well. Assign them higher multiples, but at least they somewhere guarantee you a bit of returns. And if history has a barometer, HDFC has given you those sort of returns on a CAGR basis.
You know, that is one. The other bit is what Bajaj Finance could do, right? At 3250, if they are doing that $1 billion share sale. Naturally, when that happens, their price to adjusted book gets rationalized a little bit, and therefore that stock too will not appear as expensive as it might be appearing right now. So,
yep, that's going to dilute the base with.
So both of those names should be pretty astounding. Let's see, Mahesh, between the two, if you had to put money in one.
Between HDFC Bank and Bajaj Finance, Neeraj?
Yes, let me make it difficult for you.
No, so again, I think HDFC Bank probably is on a very, very strong footing, Neeraj, at this point of time. I think the kind of advances growth that they've displayed, I think has been phenomenal over a period of time. And even as their asset base has probably gone up, I think the 20% growth that they're still eking out, I think it's relatively better on an average. The second element in terms of some kind of moderation in terms of asset quality, I think that can be well taken into their stride by the street again. Because again, I think the asset quality pressures will not be as evident on HDFC's balance sheet going forward as well. The third element in terms of the non-interest income component as well, and that component also has been moving very, very steadily going forward. The only change in terms of the management changes that might happen, I think that is the only overhang onto the stock and the valuations. But I think looking at numbers and the way they deliver, probably I think premium valuation is justified. So I think we're holding on to HDFC Bank in our stocks, and I have a bias for that as well.
Premium valuation is justified, and these are two groups which have not fallen to pitfalls of bad underwriting, and probably that's the reason we've seen the outperformance for these stocks. Very quickly, just want to get a view on Hero Moto. I think Aditya, you wanted to talk on that one?
So the stock is trading at the high point of the day. It's a good consolidation breakout that the stock has shown. So probably at current levels of 2,600, one can go long on the stock for targets of 2,700. Hold on to it for a couple of days. Put a stop somewhere around 2,550. Look for an outward target of 2,700. The other stock probably which can be watched out closely is Ujjivan Finance. That is again trading at the high point of the day. Good sharp recovery. Volumes are high on the pullback. It's almost there, so there's a minor resistance around 305. Watch that level closely. If stock manages to trade above that and close above that, bulls will regain the strength and pull the back all the way up to 320.
Okay, we will watch out for those names as well. Let's try and get you a sense of what dealing rooms are recommending in the session today as well. Darshan and Yatin join in with their channel checks. Good afternoon, both of you. Darshan, let's start off with you.
Yeah, so one of the stocks that's been spoken about today is BPCL. If you look at it, most of the PSU stocks are doing well in trade. This is what I think Yatin wants to speak about. So, yeah, BPCL is up almost 5%. Some of the domestic funds have actually bought into it among that. So, BPCL is the first stock. ICICI Bank, dealers indicate that at lower levels today, there is a a bit of HNI accumulation that's happening. The counter has corrected significantly, so at lower levels there is buying. And Cipla, after a weak first quarter and the correction that came in over the past few days, has seen steady accumulation. One of the large domestic brokerage is actively pushing this stock to its clients. So that's what's been spoken about. Yatin, what are you hearing?
Well, Yes Bank is one stock which is witnessing some short covering according to dealing room sources, 4% up for that one. So good volumes and good trading activity seen here despite flattish market conditions today. Coal India is the other one which is again witnessing some good amount of buying, 7% up for this one. So right now it's trading at the highest point in day. So good amount of volumes, almost 2 crore plus shares traded here. Dealers on the basis of F&O trends are recommending a buy today, sell tomorrow kind of a strategy here. And Equitas, that is also one stock wherein HNIs are quite active, both in the cash markets as well as in the F&O market.
Okay. Well, both the small finance banks have moved higher. Equitas, thanks for that, by the way, both of you, Darshan and Yatin. Equitas and Ujjivan, both of them are trading at a high point of the day. But talking about the PSU banks and particularly the oil marketing companies, we highlighted BPCL for you at the start of the show. The stock's up for the 9th straight session. All the oil marketing companies, HPCL too, is sitting with gains right now. So let's get a technical check going. Jayesh, on the charts, where would you take a long bet? Would it be HPCL, BPCL or IOC? Which is looking the best on the charts right now?
According to the charts, HPCL and IOC looks good. Even today we have recommended both of them to our clients. I think both of them have given a double bottom breakout. There is very high chance that we may see a continued rally of another 4 to 5% going forward. So both of them are buy, HPCL and IOC.
Mayuresh, view on these oil and gas companies which have moved higher today, oil marketing companies, even the upstream ones. ONGC has seen some gains, though the crude prices may have cooled off, Mayuresh, in the last 2 months. Do you think that impact is also being offset by rupee depreciation?
Absolutely, yes. I think that is how these variables work out. But I think within this entire basket, I think Petronet LNG probably looks a little bit safer from an earnings perspective. What they've probably done in terms of capacity expansions, it's the hedge utilization more than 100% expectations of Kochi, Mangalore ramp up expected to happen pretty fast as well, and that probably adds up to the incremental volumes. What you've seen in terms of LNG pricing as well, and generally I think the reliquefaction facilities which are probably coming through, I think that will also keep the LNG prices at check, which is basically good news for even the government to probably revive most of the gas plants, which they've already did with one of Torrent Power's Suzhou wind power plant. So in that respect, again, my own sense is that the kind of earnings growth can be a very steady one in spite of the volatility that we're probably seeing in this entire oil and gas supply chain. And with that respect, again, the ROEs, ROCs of 21%, expectations of yield being maintained at 3.5%, 4%, probably looks good. Even on an EV/EBITDA on FY21 basis, almost 6.9 times, which is again fair in my opinion. It has moved up, but again, I think the stock should remain resilient going forward as well.
Yes, some of the smaller NBFCs are correcting. Edelweiss is down for the 4th or the 5th day today. Centrum Capital is down about 3.5. The last time I remember, Motilal Oswal, the last few days also hasn't been doing all that well. So some pullback seen into a bunch of these names. Look at Centrum Capital, about 2.5% lower in the session today as well. That too is not a thinly traded stock, by the way. It's reasonably active, and MOSL too was looking slightly wobbly. Keep that at the back of your mind. What has also gone up today, I mean, while we're talking about losers, is Minda Corp. Now, somehow that stock has been just so volatile. It's down about 8-9% on a given day, then up about 11%. The last 7-day chart, or maybe the 10-day chart, if we have, we can pull that up. We'll show you some really sharp, jagged moves. Look at that. Some sharp pullbacks and then sharp upticks as well for Minda Corp. We speak about Minda Industries quite a bit. Any thoughts on Minda Corp, Mayuresh?
Sorry, Nidhi, don't track that so closely. So.
Okay, yeah, I mean, not too many people do that, but Minda and Minda Industries are more widely tracked. But this one, in its own way, has been very, very volatile the last few times. Mayuresh, any thoughts on the restaurant space? Now, I mean, I'll club in the dine outs as well out here, but Jubilant Foodwork, Westlife, specialty restaurants, and a couple of other smaller pockets. Any thoughts here at all? The SSG growth for some of these was a bit disappointing, but come festive season, do you reckon these might see some earnings beta?
So again, I think the hope was there, Dheeraj, and again, I think if you've historically seen it, the SSG growth, specifically in the quarter gone by, where the World Cup was on, the Cricket World Cup, I think the SSG growth actually grows humongously, but it did not happen this time around, and clearly I think competition intensity is being displayed at this point of time. So I think the market aggregators, the unlisted players, within this QSR space itself. And again, I think the cost of running these operations, if you're having a dine out or you're probably having a takeaway, I think the takeaway restaurants far lesser fixed and operating costs to probably work with. And in that respect, again, I think the competition pressures probably play out. And there is every hope that when the festive season comes up, the SSG growth should show some amount of resilience. Maybe on a quarter-on-quarter basis, I think it should hold up or improve. But when you're probably talking about a year-on-year basis, again, I think there will be significant amount of correction that we'll probably see. And again, the hope that I think there will be some respite happening on this front, I think that will get displayed by numbers. So I think if the growth disappoints, both in terms of SSG and again margin pressures being evident because of competition intensity, I think it's very difficult to justify the kind of valuations that these players are enjoying. So I'll wait and watch for the Q2 numbers to probably come out and then probably take a call.
Okay, just 10 minutes to go for markets to shut shop. Let's get you some closing strategies from our technical experts. Aditya, any STBT or any BTST for tomorrow?
So I'll go in for a BTST. The one just I recommended, I'll stick to that. Hero MotoCorp can be taken along at current levels of 2610, 2609 for targets of 2700 and higher. Put a stop somewhere around 2550. Probably Aurobindo Pharma can also be considered. These two stocks look extremely strong on the charts. Aurobindo Pharma has also moved to the high point of the day. This could also be a BTST trade at current levels of 613. Initiate long positions for targets of 625, 640. Put a stop somewhere around 590.
Okay, so Aditya is sticking to his earlier buy call on Hero MotoCorp. Jayesh, what about you? Your closing strategy would be?
See, I have a buy and a sell call. First one would be Dr. Reddy's. Currently, it is trading around 2688 odd levels. The stock has given a consolidation breakout in today's trade. I think the stock can easily move up to 2800 levels in the coming days. So you can buy the stock at the current market price with a stop of 2600 and target price of 2800. Second stock would be a sell on LIC Housing Finance. If you see the weekly chart, the stock is on a verge of giving a head and shoulder breakdown, which is a very long-term breakdown. I think there is very high chance that if it crosses 385, 388 levels on the downside, we may see a sharp correction in the stock. So it is not kind of a STBT trade, but you can do it as a positional trade, wherein the stop loss for the same would be around 410 odd levels, and immediate target would be around 355 to 360 odd levels.
Okay, sell on LIC Housing Finance, and a couple of these pharma stocks where we've already received some technical buy calls are seeing buying interest. I think Lupin is also up about 3% in trade today, but Tata Motors, that's your top gainer on Nifty, sitting with gains of 8%. Aditya has already mentioned he's not going to play this pullback rally on Tata Motors, so let me get a fundamental view here. Mayuresh, would you recommend bottom fishing into these auto stocks and especially Tata Motors?
So, sir, I think we've had a discussion over the past few months, and I've always maintained the stance. You need to wait out. I think there is no need to rush into these stocks. What you're probably seeing and witnessing in terms of volumes, I think the volumes are just not growing. Month on month, there might be some amount of respite, and there is every hope that the wholesale channel or the dealer network push through has happened. But what actually happens at the dealer level over the next few months in the festive season is going to be very, very interesting. So whether they have to resort to discounting and whether that probably gets played out in terms of a lower earnings profile, because a lot of managements, as I've time and again said, have mentioned categorically that this financial year is going to be flattish at best, which means there is going to be no earnings growth. So the only hope probably remains from the festive season and any built up after that, assuming the Rabi season probably plays out as one expects and the realizations thereof start coming through at the end of the third quarter. But again, there is hope at this point of time. So I mean, I'll not be betting on stocks based on hope, but on facts and figures. So I think let the numbers come out. the premise, as I've always maintained, is to wait and watch. I think there is no need to rush into these stocks.
Okay. Well, a lot of people would argue that that's probably a sane strategy to do as well. By the way, it's not just some of the likes of HDFC Bank, even Kotak Bank, for example, the last 5-6 days has corrected about 6-7%. So a lot of quality names have indeed come off the last few days. Keep that at the back of your mind. Real estate too looks slightly wobbly. Oberoi Realty is down 3.5. DLF is down to 158. So some large developers are correcting in the session today. Are you looking at this pocket at all right now, Mayuresh, or there is enough available outside real estate to ignore it completely?
So again, like autos, I think there is still too much pain in my opinion. Again, inventory levels are still pretty high in the system itself. What you've probably seen in terms of new launches, I think specific investors or developers have probably done that at this point of time. But the sales velocity, I think, is very, very tepid. I think except for a few projects, as I said, I think the sales velocity still remains extremely poor. And the fourth point obviously is the high leverage on a lot of company balance sheets. When that puts additional pressure in terms of top line not growing, volumes not growing, and expectations of how the future sales will be is a large unknown at this point of time. So again, I think we have a very, very specific exposure for the real estate. I think Godrej Properties is something that we still continue to own. But again, at this point of time, I think it's a tad bit expensive. It's a clear disclaimer from a holding perspective, but at this point of time, I think I'm not chasing any real estate stocks.
All right, Mayuresh, we'll leave it at that. Thanks so much for taking the time out and speaking to us. The reason I was thinking of that was because the FinMin apparently, I think one of the wires are saying that the FinMin is finalizing the stimulus measures for home buyers and the real estate sector. The news was due to come out last Wednesday or last Thursday. We haven't gotten it as yet. I don't know if it'll happen tomorrow because they made a habit of getting out news on Friday. So maybe we'll get something like that tomorrow. Let's wait and watch.
Fridays have become exciting.
Yeah, well, and
post-market.
For
Monday morning.
And post-market is even more. So that's the thing, really. But yep, these stocks are looking slightly wobbly though. Aditya, DLF and Oberoi Realty on the chart.
I would stick in with Mayuresh's view. I would avoid both the stocks.
You wouldn't even go short?
I would not go short because of the fact that the stock has already corrected significantly from 180 to about 140. Then it made a pullback. So taking a short position will be like burning your fingers. Probably it's best avoided rather than burning money. You never know which way these stocks move these days.
Okay, we'll maybe leave the real estate names out. As before we wrap up or start wrapping up the market, the stock which is the top loser on the Nifty 500 is Kesoram. Usually doesn't come in the realms of conversation, but Vaibhav, any thoughts here on Kesoram? Jayesh, any thoughts here on Kesoram? It's not very liquid, but it's down about 5% in the session today. Is it possible to track the charts there?
See, the stock is continuously trading in a lower top, lower bottom chart structure. If you see today's move, the volume is actually higher than I think the average of last 20 odd days. So it is indicating that somebody is exiting the stock. And even we have seen that major small cap stocks have been tumbling because of that SEBI circular. So on that count, I think the stock may even trend lower up to the levels of 42 to 43 odd levels in the coming days. So I would not advise anybody to go long in this stock. It can correct further.
Sure, Jayesh, Aditya, stay on. We'll just start wrapping up the markets and then come back to you for your final comments. But absolutely flat for the benchmark indices. Banks gave up half of the gains that they had yesterday. And that's been the story of the Nifty Bank. Some large names down for a day, really. I don't think this news is so big that it will have a continuous impact on HDFCs and ICICI banks, etc. So I believe the damage for the day is done when it comes to the news flow that happened overnight last evening, with the presumption that that's the reason why these stocks are down. The mid caps and the small cap and those indices, arguably, obviously, not doing as well as yesterday, but still ending in the green. So the market breadth might be a bit favorable. We'll get to that in a bit. First, the index movers, what's gained and what's not. What's gained, firstly, Tata Motors, 8.5%. Autos, metal names, and PSUs. Those are the three buckets which have done extremely well. Just the fact remains that because they are not heavyweights, we haven't had too much of a gain move in them, but essentially those are the three buckets that have done very well for themselves in the session today. Across the board, autos, metals, and PSUs have done well. What has not done well? Well, HDFC down about 2.8%. There is weakness in India Bulls about 2.5%. ICICI Bank about 2.5%. TCS 1.5%. IT's taken a bit of a backseat in the session today, and down there HUL, and amongst heavyweights HDFC Bank, even though it's down only 0.8%, it might well be in the realms of the top contributors. We'll get to know about that in a bit. But yeah, some heavyweights, the likes of HDFC, ICICI, TCS, all of them correcting quite strongly today. Navneet, what about the broader end of the spectrum? Is the breadth positive?
Yes, it is, and a better day for at least the broader markets. A lot of stocks moved around. There was short covering rally also seen for a couple of these stocks. But let me start off with the small finance banks, which surged in the second half. I think in the last hour of trade, you had Equitas and Ujjivan both closing at day's high. Equitas up about 5 to 5.5%, and Ujjivan also surging alongside that, closing with gains of nearly 6% in trade. Shankara Building was the other one which surged, and that stock was very close to being locked in upper circuit, and I guess, yep, 20% higher, so that will be closing with upper circuit as well. Kiri Industries is the other one which went up in trade. Volumes were quite decent for this one, 16 to 17% gains seen. Minda Corp, now this has been a volatile counter in the recent past. One day it's up, second day it gives up its gains, but I guess this too is locked in upper circuit with gains of 10%. Lupin, where Morgan Stanley came out with a report, they maintained their rating of overweight with a target price of 1,003. So a lot of pharma stocks picked up momentum, and this one was one of them, 3% higher. Kajaria Ceramics was up about 5 to 6% in trade, the F&O counter closing at day's high. And you also had Motherson Sumi, where HSBC maintained their rating of buy, but they cut down the target price of 215 from 170. Some bounce backs seen, considering Motherson Sumi is a beaten down counter. We have seen a lot of stock correction in the recent past. On the losing side, LIC Housing, third straight day of fall. Fresh shorting continues for this one, down 4 to 5%, closing at day's low. M&M Financial was the other one which saw some cuts in today's session, so that's also closing at the lowest point of the day. DLF was down, and let's see if there was any recovery actually seen for this one in the second half. Yes, actually it's closing off the day's low, but still with cuts of about 2.5%. Federal Bank, the entire banking space was weak, and this one was also down, though the losses were marginal. It was down only about 1%. And lastly, Magma FinCorp, where the stock registered its 7th straight day of fall. So this one continues to be weak, closing with cuts of about 3.5%, Neeraj.
Let's start. Well, that's essentially the sum and substance of what's happened in trade today. I want to bring up the market breadth firstly for our viewers, because while the Nifty Bank dragged the benchmark indices lower, the broader end of the spectrum was doing okay, and which is why you have a breadth which is almost, well, slightly less than 2:1 in favor of the advances, which is quite spectacular. But the contributors, Navneet, and I wonder if HDFC Bank has jostled its way in, because a lot of other heavyweights fell. Yeah, well, there.
It has to feature.
it is almost there, yeah. But lots of heavyweights falling today, which is essentially the problem.
Some bit of support coming in from Infi today and Coal India, though it's not a heavyweight on the index. But if you can just pull up the intraday chart of another heavyweight, that's Reliance Industries. Aditi just pointed out, I think it's closing at the lowest point. It did fall, and since last week, I think Reliance Industries has been underperforming compared to the markets.
Yeah, maybe at some point of time it will stop underperforming as well, and maybe that gives a bit of a support. Let's wait and watch. Lastly, the turnover should come up on your screen. Should be higher, the F&O turnover at least, because it's expiry.
Yes, it is on the higher side. 25, 26 is something which we usually see on a monthly expiry day as well. So it does appear to be on the higher side. But the cash one, Neeraj, that's slightly below. I think yesterday we were somewhere about 30,000 to 30,500 crore. There is lack of participation. Even if you look at the average turnover for the month of August was lesser than what we recorded in July.
Yeah, well, so that's the sum and substance of today's close. Let's get in the final thoughts from both of our experts. Jayesh, to you first. With the kind of close that the Nifty Bank has shown, do you sense pressure there, and could that drag the indices lower further?
As of now, if you see the stock, I mean the index has not been able to cross its 10-day EMA since July 8. If you see in last 2 to 3 months, every time the index has tested its 10-day exponential moving average, it has retraced back and broken its previous low. So even today, if you see, it tested its 10-day EMA and we saw 350 odd points correction in the index. So as of now, if you look at the charts, 26,500 to 26,600 will act as a very strong support for the index. In case if it breaches that level, only then I would like to initiate a bearish trade. Apart from that, I think it will trade in that band and once it breaches its 10-day EMA, only then I would recommend to buy. As of now, it is trading in a no trade zone, so I would like to avoid it. But since whenever it breaks the 10-day EMA on the upside or 26,600 on the downside, a bullish or a bearish trade can be initiated.
At least for the day, it's closing below psychological level of 27,000. That's Bank Nifty. Aditya, closing thoughts from you?
As far as the Nifty is concerned, market didn't do much. It was almost flat. So I would not take a trade, as I mentioned at the start of the show as well. I would wait for the bulls to take the market above 10,900, 10,920 zone. Above that, that would also mark a higher high for the index on a very ultra short-term time frame. Then, in that case, my targets could be 11,050, 11,150 on the upside. Till the market does that, closes above 10,900 and 920, I would avoid taking any long positions. On the downside, bulls are providing some support around 10,800 or 10,750. We'll watch out for those zones on the downside closely. My sense is market will consolidate for a couple of trading sessions before it gives a move on either side whenever happens.
Okay, gentlemen, we leave it at that. Jayesh as well as Aditya, thank you so much for taking the time out and speaking with us today on Bloomberg Quint. Really appreciate your time. And with that, it's a wrap on this leg of Countdown from Navneet, myself and the team that put this show together. Thanks so much for watching. Stay tuned. The market wrap comes up next.